So this is going to be another quick impromptu video answering some trading questions I've gotten more in real life than online. People over the years have learned that I'm an active trader, and they always say something to me like, "Oh, the market rallied today. You must have made a lot of money." And I'm like, "Well, no, I'm actually kind of short." And so the question is always, why are you short the market? And even at a time where I'm relatively bullish, this is I'm kind of at the beginning of this virus mayhem. And even though I think the market is oversold and we're due for a bounce, I'm still not particularly long and trying to stay a tiny bit short. So I hope to answer that question. This is not going to be a coding video per se or numerical methods video, but I just want to, I'm actually going to use some Python to demonstrate why I always maintain a little bit of short delta. So I am basically a premium seller. And so basically I sell options. My default strategy is a short strangle. I will sell iron condors, I will sell vertical call spreads, individual calls, naked puts or whatever, but I'm always short premium, which means I'm long theta and short volatility. So in this notebook here, which I've already prepared, this is just stuff from the Black-Scholes model we've done before. I'm going to simulate a strangle here of a strike price, $100 stock right here. Put strike is 95, call strike is 105, so it's a $10 wide short strangle, and I just made up a risk-free rate of 1%. And again, time to expiration, I'm just going to take to be 40 days, and an implied volatility of about 17%. So, and I calculate the price of the call, the price of the put, and obviously the strangle price is the sum of those two. And if we run this sell, which I've already done, you get a strangle price of about a buck, little more than a $1.15. Call it a $1.16. Now, obviously, there are several variables that go into pricing an option, but obviously, again, time is very predictable. Time is going to go by regardless of whatever happens. Interest rates do fluctuate, but not that rapidly, so I'm just going to ignore that and talk about what happens with the movement in volatility and the movement in stock price. And the movement in stock price is pretty obvious, so I'm just going to kind of put that off on the back burner and just touch on it briefly in a few minutes. So what happens if volatility increases? So I'm just going to print out the prices of the options as a function of volatility. So I've created a bunch of potential volatility numbers here. So it's going to range from basically 5% up to 145%, I believe is the last number. So if we actually calculate that, you see that the price of an option with a volatility of 15%, or no, what did I say it was? 5% implied volatility is pretty low. It's about 64%. But by the time we get up to 145%, we're already up to $16. And if we plot that out, this is what it looks like. There's a little kind of a curvature area down here, and then it increases linearly. And obviously this increases orders of magnitude over this volatility range here. So that's basically what would happen if the stock price did not change and you had a very sharp increase in volatility without much time going by. And that makes sense too, because I just said at the beginning, short strangle, short premium is essentially short volatility. So we would expect if volatility were to expand, we'd end up losing money. Okay then, what happens now if the stock price fluctuates? Well, that's pretty obvious. Let's just go over here to Wikipedia, and here's the article on strangles, and let's just zoom in here. And this is the risk graph of a short strangle at expiration. So if the stock price moves beyond our short strike, we begin to lose money linearly, dollar for dollar with the price. And once we're past our break even, we're just losing money dollar for dollar. And that could be on both sides, calls and puts. So if the stock drops a lot, our strike and break even are going to be breached, and we're going to end up losing money due to stock movement. And all of that is pretty obvious, I think, so I'm not going to dwell on it at all. But we have to ask the question, what's the relationship between stock movement and implied volatility? So let's go back here, and I have loaded the historical values of the S&P 500 index and the historical values of the VIX index. And I'm going to use the VIX as a proxy for implied volatility, because essentially it is the implied volatility of the S&P 500 index. So I'm not going to do anything really all that formal here. I'm just going to plot out the S&P and VIX indices right next to each other for the last 50 trading sessions. So this is starting right before all this chaos started. And you can see, well, you're probably on this scale, you can't see it, but the ES was drifting up, and then all of a sudden we crashed down. And the VIX did the exact opposite. It was just fluctuating around fairly low value. Well, actually, this is a relative. It was kind of a low value for a while, and then it shot up. So down markets, as the market sells off, implied volatility goes up. And I didn't plot it here. You can plot it for yourself. But you can see that the opposite is true. As the market goes up, implied volatility goes down. And if we come back here, and you notice, where did I put it? Right here. And this initial strangle, I sold it for implied volatility of 17%. And if we go back here and look at, like, if volatility were 5%, that strangle would come in by what? This is 60 something cents, and the initial price was $1.15. So it would come in 55 cents or so just from volatility collapsing if the vol were to drop suddenly and the stock price stayed the same. So the opposite is true when the market sells off. So if we have a sell-off, and obviously in a sell-off like we've had recently, your short strike has been breached, and not only you're losing on your deltas, but you are losing on volatility expansion as well. So how do you offset that? Well, you maintain a little bit of short delta all the time, because as the market goes up, volatility will come in, and you may be losing money on your delta, but you are making it on volatility contraction, and hopefully the vol contraction offsets or exceeds the amount you lose on delta, and that's generally the case. And as the market sells off, you need protection because vol just can go right through the roof. And a tad bit more formally here, I looked at the correlation between the S&P and the VIX, and I expected this to be a little higher. This is the Pearson coefficient. It's about minus 0.77, so it's an inversely correlated underlying. And probably the better one to look at is the Spearman coefficient, and that is right here. That's minus 0.8 roughly. If memory serves, they were higher. Maybe I should go back and look and make sure these numbers are correct, but still, they're strongly inversely correlated. So in the future, in another video, I think I will go back and look at the size of moves, kind of do a statistical breakdown of the size of moves in the S&P and the VIX, and how often does the VIX contract as opposed to expand and things like that. But for now, I would just call it quits. And the short answer to the question, why am I always short delta? Well, it's a hedge against volatility expansion because I'm also short volatility. So, cool. Until next time, see ya.